When history books are written, people will look back at this period and recognize the sharp rise in inflation. This inflationary spike was largely driven by massive supply chain disruptions, primarily caused by the COVID-19 pandemic and the war in Ukraine. As a result, we saw a rapid increase in prices, but while it may feel like inflation is slowly easing, historical charts will likely depict this decline as very steep. Over time, we are likely to descend into deflationary territory, and in hindsight, the Federal Reserve, the Fed, may be blamed for steering the economy into this downturn. Don Lewin wrote an editorial piece in the Wall Street Journal discussing this exact concern. We are already witnessing warning signs from major companies, such as Home Depot, which reported that same-store sales are expected to decline by 3% to 5% for the year. Many businesses are bracing for a hard landing, and this downturn will be evident in both units sold and overall pricing. A growing number of firms are reporting such trends in their earnings reports. One of the challenges, as with economic statistics, is that they dominate discussions, yet they are often lagging indicators. In many cases, they fail to capture the true picture. Gross domestic product, GDP, for instance, is a statistic that was developed during the industrial age. However, we now live in a digital era where gross domestic income, GDI, tends to be a more accurate measure of economic activity. The gap between GDP and GDI is currently at a record level, and GDI has been in negative territory, essentially a recession signal for 2 consecutive quarters. NVIDIA and AI, a shifting investment landscape. We have remained highly optimistic about NVIDIA, having invested when its stock was near $100. Since then, it has tripled in value, while many of our other AI-oriented stocks remained stagnant. Contrary to some perceptions, we are not just blindly following the hype. We are actively assessing relative valuations within the AI space. NVIDIA is currently valued at about 25 times sales, whereas Tesla, a company we consider to be the most significant AI play, is trading at only 6 times sales. Similarly, UiPath, another promising AI-driven company, is also valued at 6 times sales. While NVIDIA remains a strong investment, there are factors that warrant caution. First, NVIDIA operates within a cyclical industry. Whenever there is a consistent narrative about shortages of GPUs or other computing resources, it raises concerns about the cyclicality of the sector. Additionally, competition is increasing. Tesla, Meta, and Google are all developing their own chips for specialized AI models, which could reduce their reliance on NVIDIA's hardware. From a technological standpoint, companies like Meta have demonstrated that large AI models, such as Llama, can operate efficiently with less computing power but more data. This means that NVIDIA's dominance in AI chips could face disruption as the industry evolves. Despite these risks, NVIDIA still meets our minimum investment hurdle rate of a 15% compound annual return over 5 years. It remains a key part of our specialized portfolios, but we are actively seeking better value opportunities in the AI space, the future of Google, Apple, and Amazon in an AI-driven world. The rise of AI, particularly ChatGPT and similar technologies, could pose a significant threat to Google's core business model. Search engines have historically relied on advertising revenue, but AI-driven solutions may reduce the need for traditional search altogether. If users can obtain precise answers from AI without searching multiple links, Google's advertising revenue could take a hit. Apple and Amazon may also face disruption. Social commerce, where people shop directly through platforms like Instagram and Pinterest, is growing. Moreover, AI could facilitate direct-to-consumer transactions by allowing users to request specific products at the lowest price, bypassing traditional e-commerce intermediaries like Amazon. Meta is another interesting player in this space. We appreciate its AI-driven approach, especially with Mark Zuckerberg now prioritizing artificial intelligence over the metaverse, which was his primary focus last year. While we do not hold Meta in our flagship portfolio, we have allocated it to other investment strategies. Tesla's AI and autonomous taxi network. A trillion-dollar opportunity. Tesla is arguably the most advanced AI company in the world. Its data collection on real-world driving miles surpasses that of all other automotive and technology companies combined, excluding perhaps China, where data accessibility remains uncertain. We firmly believe that the autonomous taxi network Tesla is building will be a game-changer. The company that can provide the fastest, safest autonomous rides from point A to point B is likely to dominate the market. In the U.S., we expect Tesla to take the lead, and globally, this market could scale from zero today to an estimated $8 to $10 trillion in annual revenues by 2030. Tesla's AI expertise is not limited to its vehicles. It is also revolutionizing the manufacturing process, using AI to build more efficient factories and optimize production lines. Tesla is becoming a leader not only in automobile production, but in AI-driven industrial efficiency. Market challenges, investor psychology, and algorithmic trading. As markets fluctuate, investor sentiment plays a crucial role. One of my biggest concerns is that market downturns disproportionately impact our investment strategies. While we advocate for a 5-year investment horizon, some investors panic when they check their accounts daily. A key issue in the current market is the prevalence of fear, uncertainty, and doubt, FUD. When Fed Chairman Jerome Powell shifted from calling inflation transitory to acknowledging that it might persist, it unsettled the markets. This uncertainty has driven investors back to traditional benchmarks, and since our portfolios often contain non-benchmark stocks, those stocks tend to be sold off first. We've seen this pattern before. Investors flee from innovation stocks, while we take the opposite approach, concentrating our portfolios on high-conviction investments that have been disproportionately punished by the market. Another factor affecting stock movements is tax loss selling, which should wind down soon. Additionally, many young investors have taken on leverage, and broader market margin positions are also being unwound, contributing to recent volatility. Exponential growth, converging technologies, and AI's broader impact. Most investors are unfamiliar with exponential growth and the convergence of multiple technological advancements. The autonomous taxi industry, for example, brings together AI, robotics, and energy storage in a way that could generate trillions in new revenue. Market algorithms also play a role in the current landscape. More than half of today's trading volume is algorithm-driven, and these algorithms rely on historical data rather than forward-looking insights. This can exacerbate market inefficiencies, as they do not account for the transformative potential of emerging technologies. Another area of interest is the evolving labor market, the rise of decentralized finance, DeFi, decentralized autonomous organizations, DAOs, and non-fungible tokens, NFTs, could have profound long-term impacts. We plan to conduct further research into how these technologies will shape employment trends. The long-term investment outlook. Despite the recent sell-off in innovation stocks, we believe these companies will be the long-term winners. Many of these stocks are currently trading at a quarter to a third of their peak valuations earlier this year. As inflation stabilizes and recession fears materialize, value stocks may struggle, while innovation-driven companies could see a resurgence. In February, our strategies projected a 15% annual compounded return over the next 5 years, equating to a doubling of investments. Given the current market conditions, we now believe our strategies, particularly those centered around disruptive innovation, could deliver close to a 40% annual compounded return over 5 years. This represents a potential 5-fold increase, making us even more optimistic about our investment outlook today than we were at the beginning of the year. Ultimately, while short-term market fluctuations may create fear, the long-term potential of AI, autonomous technology, and digital innovation is undeniable. We remain committed to identifying the best opportunities in this rapidly evolving landscape.